Palantir is sitting 28% below its all-time high. Year to date, the stock is down 18%. After one of the most explosive runs in recent market history, investors are now asking one question: is this a buying opportunity, or is the sell-off just getting started? I ran a full DCF and sensitivity analysis to find out. The results might surprise you. Let's get into it. But first, what does Palantir actually do? Simple. They build AI and data software for governments and enterprises. 3 platforms: Gotham for defense and intelligence, Foundry for large corporations, and AIP, the artificial intelligence platform, which is the product that sent this stock to the moon. AIP connects AI models directly to real business operations. No fluff, no DMOS, actual deployment. And that's exactly what the market has been paying an enormous premium for. The question is, does the premium make sense? Let's look at the numbers and find out. Let's start with revenue, because this is where Palantir's story gets truly remarkable. In 2025, Palantir generated $4.5 billion in revenue, growing 56% year over year. But what makes this number special is not just the size, it's the acceleration. Q4 alone grew 70% year over year, the fastest quarterly growth rate in the company's entire public history. And the engine behind it is the U.S. commercial segment, which grew 137% year over year in Q4. That is AIP in action. Now let's go through the margins, all of them, because this is where you really understand the business. Gross margin came in at 82% for the full year. To put that in perspective, that is higher than Google, higher than Microsoft, and in the same league as the best pure software businesses on the planet. It tells you that Palantir's core product economics are exceptional. Every dollar of revenue costs almost nothing to deliver. Operating margin was 32% for the full year. Again, exceptional for a company growing at this pace. Most high-growth software companies are still burning cash at this stage. Net margin came in at around 36% for the full year. Real profitability, not accounting tricks. Free cash flow margin 47% for the full year. This is extremely high for a software company. Even elite SaaS companies usually sit around 25–35%. And then there is ROIC, return on invested capital. Palantir's ROIC is over 136%. Now, before you think that's a typo, it's not. But it needs context. Palantir runs an almost entirely asset-light business. They have virtually no physical infrastructure, no factories, no heavy equipment. Their invested capital base is tiny relative to the profits they generate, which mathematically produces an astronomical ROIC. It is a genuine reflection of how efficient this business is, but it's important to understand why the number looks the way it does. Since going public, Palantir has increased its share count every single year without exception. In 2023, shares grew 4.8%. In 2024, 6.3%. In 2025, 2.24%. Today there are 2.4 billion shares outstanding. That dilution is funded almost entirely by stock-based compensation, $684 million worth in 2025 alone. This is real money coming out of shareholders' pockets. The good news is the dilution rate is slowing. The bad news is it's still happening. On the other side of the balance sheet, and this is genuinely impressive, Palantir carries almost zero debt. And they sit on $7.2 billion in cash and short-term treasuries. That is not just a safety net, it is a strategic weapon. It means they can invest aggressively, acquire, or simply wait out any downturn without ever needing to raise capital. It also directly reduces the risk profile of the business, which is one of the reasons I used a 10% WACC in the DCF rather than the higher rate that Palantir's beta would technically suggest. When it comes to growth, Palantir really stands out. Revenue is projected to grow 52% over the next 2 years, while EPS is expected to surge 61.2%. Even long-term EPS growth estimates sit at 45.9%. In short, this is a fast grower. The company isn't just growing, it's accelerating, with earnings increasing even faster than revenue. So to summarize the financial picture: exceptional margins, strong and improving profitability, enormous free cash flow, a fortress balance sheet, very fast growth, and a dilution problem that is real but slowly improving. The business could not be much stronger. But the major issue with Palantir is valuation. The trailing 12-month PE sits at 235.7, which is extremely high. Price to free cash flow is 169, a bit lower but still very expensive. Forward PE is 103.2 and the PEG ratio is 2.2. Overall, it all looks very pricey, and now we're going to find out whether the current price is actually justified. Now let's break down discounted cash flow analysis for Palantir. I've modeled out 3 scenarios over the next 10 years, a base case, a bull case for optimistic growth, and a bear case for a more conservative outlook. All the assumptions are in front of you, so I won't go too deep into each one. Just conceptually, the base case reflects normalized expectations. The bull case assumes stronger growth and margins. And the bear case builds in more conservative downside assumptions. For our terminal value calculation, we're using 2 distinct methodologies to triangulate a fair value estimate. Let's start with the Gordon growth method, which assumes Palantir will grow at a steady rate in perpetuity after our 10-year forecast period. In our base case scenario, assuming moderate revenue growth that decelerates from 61% in year 1 down to 7% by year 10, we arrive at a target price of $40.87 per share. This represents a balanced view of the company's long-term value. Our bull case is significantly more optimistic. Here we're modeling aggressive revenue growth starting at 70% in year 1, sustained strong execution, and expanding margins reaching 52% EBIT margin by 2036. This bull scenario values Palantir at $101.46 per share, more than double the base case. This would reflect Palantir successfully scaling its government and commercial segments while maintaining pricing power. Conversely, our bear case presents a more cautious scenario with slower initial growth of just 35%, facing increased competition or slower adoption rates. In this downside scenario, Palantir's valuation compresses to just $14.28 per share, emphasizing the importance of the company's growth narrative. Weighting these scenarios by their probability, 65% for base, 20% for bull, and 15% for bear, we arrive at a weighted target price of $49 per share using the Gordon growth method. But let's also look at this through a different lens, the exit multiple method. This approach assumes Palantir will be valued based on a multiple of its terminal EBITDA in 2036. We're applying a 50x EBITDA multiple in the base case. Why 50x? This reflects Palantir's premium positioning as a leading AI and data analytics company. Software businesses with high-margin, mission-critical solutions typically command higher multiples. In the bull case, we're even more aggressive with a 60x exit multiple. This assumes Palantir becomes a dominant force in enterprise AI, commanding a Salesforce or MongoDB-level valuation multiple. Under this scenario, the valuation explodes to $339.74 per share. This is where the real wealth creation happens if Palantir executes flawlessly on its AI and commercial expansion roadmap. The bear case applies a more conservative 40x multiple, resulting in a $38.01 per share valuation. This reflects concerns about competitive pressures or slower commercial adoption than expected. Applying the same probability weights, 65% base, 20% bull, 15% bear, the exit multiple method gives us a weighted target price of $156.93 per share. So what do we make of these 2 very different valuation approaches? The Gordon growth method gives us a $49 fair value target. This is the most theoretically sound approach. It assumes Palantir reaches a mature, steady-state growth pattern and values it based on sustainable cash flows. Essentially, we're treating it like what it actually is, a maturing software company. The exit multiple method, on the other hand, gives us $157 per share. But here's the critical question. Is this realistic? This approach assumes investors will still be willing to pay a 60x EBITDA multiple for Palantir in 2036. That's an exceptional multiple, comparable to the most dominant, highest-growth software companies in the world. And that's where we identify the real problem. Palantir is a premium quality company, there's no denying that. The software is best in class, the government relationships are fortress-like, and the commercial expansion is progressing well. The margins are impressive. The business quality is legitimate. But the current market valuation is disconnected from these fundamentals, in my opinion. Alright, so after running the DCF, I'm moving to a sensitivity analysis. This is a 5-year price projection where, instead of focusing purely on intrinsic value, I'm stress testing what kind of returns we can realistically expect under different assumptions. Now, one key assumption here is that I expect a meaningful P multiple compression over the next 5 years. The easiest way to understand this is by looking at Amazon as an example. If we look at Amazon's stock performance over the past 5 years, the stock is up only around 30%. And the natural question is, why so little, especially for a company of that quality? A big part of the answer is valuation. Amazon was trading at a very elevated multiple for a long time. If you look at the PE over that period, the average was around 82, which is already quite high. And that's actually significantly lower than what we see with Palantir today. Also, if you look at where Amazon's PE multiple is now, it's much lower than it used to be. So what happened is that even though the business kept growing, a lot of that growth was offset by multiple compression. And this is exactly the dynamic I expect to play out here. Palantir is currently trading at a P multiple of well over 200, which is extremely elevated. At that level, it becomes very difficult for the stock to sustain strong returns purely through fundamentals. So even if the company continues to execute well, a normalization of the multiple is very likely over time. And because of that, I'm deliberately not assuming aggressive valuation multiples in my model. So in terms of assumptions, for valuation multiples, I'm using a PE of 50 in the base case, 60 in the bull case, and 40 in the bear case. For growth, I'm using revenue growth broadly in line with analyst expectations, so 45% in the base case, 50% in the bull case, and 40% in the bear case. My target is a 15% annual return over 5 years, and I'm applying a 10% margin of safety. Now, looking at the results, in the base case, the entry price required to achieve my target return is $100, and after applying the margin of safety, that comes down to 90.34. From today's price, that translates to roughly a 6.3% compound annual return, which is honestly quite underwhelming. In the bull case, the entry price comes out to $142, and after the margin of safety, that's $128, which implies about a 14.1% annual return, so at least closer to the target. In the bear case, the entry price is $67, and after the margin of safety, it's $60.04, which actually implies a negative return of around minus 1.8% per year, so clearly not attractive. Finally, if I assign probabilities of 65% to the base case, 20% to the bull case, and 15% to the bear case, I get a probability-weighted entry price of $93.51. Now, taking this a step further, I also built a sensitivity table where returns vary depending on both the PE multiple and the growth rate. And this is where things get quite revealing. If we look at a growth rate of around 46%, which is broadly in line with analyst expectations, attractive returns only start to appear at around a 72 PE multiple. And in my view, that's already quite an aggressive assumption, especially considering that I expect multiple compression over time. So what this basically shows is that even if Palantir delivers strong growth, the valuation still plays a critical role. At current levels, the stock requires not just execution, but also a sustained high multiple, which, in my opinion, is unlikely over a longer time horizon. Now, I also built a similar sensitivity table, but this time based on a specific entry price. From the previous analysis, my probability-weighted entry price came out to around 93.5, so for simplicity, I'm using 95 as a reference point here. And this is where the picture starts to look much more interesting. At a growth rate of around 46%, which is in line with analyst expectations, returns become very attractive starting from roughly a 46 PE multiple. So compared to the previous scenario, the key difference here is the entry price. Once you lower your entry, the whole setup becomes significantly more favorable. So overall, my conclusion is pretty simple. At current levels, Palantir doesn't really look that attractive to me. But if the price drops closer to around 100, that's where things start to get interesting, and that's the level where I would personally get much more excited about the stock. If you found this analysis useful, feel free to like the video and subscribe. It really helps the channel. Thanks for watching.